In this video, we're going to look at Q4, the LA Fires 2025, guidance for 2025, and the general catalyst synthetic agent renewals. So in an earlier Q4 video from several weeks ago, I was saying there's a chance they have a huge in-force premium beat, possibly beating 1 billion based on this interview with Daniel. Shai even replied to that, said not yet. So we know that they're probably not having a huge, massive IFP beat, but their guidance for in-force premium, their guidance for Q4 IFP in-force premium was 940 to 944, so call it 942 million was where they're expecting that to come in at. Adjusted EBITDA loss of minus 29 to minus 25 million. And if we look at this tweet here, a slide from Investor Day that Aaron did some pixel counting on, it looked like they're going to have, this shows 65 million in adjusted gross profit in Q4, but based on this, the amount of gray relative gray in the slide. But talking with Aaron further, counted a little more closely, it's probably more like 60 million would be a more precise measurement. So that's sort of what we're guiding for, or understanding for Q4. We also know for Q4, they told us from Q3 earnings call that they're expecting to spend about 35 million on their growth spend in the quarter. So the growth spend is continuing to ramp up based on these values, based on what they're spending on growth. For the IFP in-force premium of Q4, I'm looking at maybe a 959 million amount. It's a bit of a calculation here. There's a bit of adjustment and assumptions based on rates increases still coming online, but also home policies being non-renewed. A lot of things going on there, but expecting, maybe a 950, it's hard to predict this, but 959 million might be a reasonable beat. A beat of 959 over their guidance of 942 million would be a beat of about 1.8%, which is in line with where they have roughly beat that or even more in their guidance. So I think that's a reasonable assumption on where IFP might come in. Now, for their loss ratio, I have it right now at 63%, which would be, I think, a really, really stellar loss ratio for Q4. Remember, there was no LA fires that happened in Q4. It's a quarter that often has better loss ratios. If we flip ahead here, you can see that this is from the Q3 earnings letter. You can see gross loss ratio ex-cat was in Q1 and Q2 was 63%, 62%, 68% in Q3. And now you kind of think about it. If you have very minimal cat, so maybe catastrophic losses were 6% in Q3, but maybe they're only 1-2% in Q4 because it was a very low catastrophic quarter. Seems like when you're looking at other insurers that have reported already. So if that number is really, really low, and say their worst policies that are home policies that have the highest loss ratios, 100 plus loss ratios, are being canceled and were canceled in Q3 and Q4 continue to be canceled, and then you're continuing to increase your rates, and those higher rates are taking hold on new customers, which improves their loss ratio, you should have a trend that continues down. So I'm thinking, I'm inputting 63% just based on these sort of the trend you're seeing here, and also 63% with that amount gets you to adjusted gross profit of right about that 60 million mark that we saw from that slide that Aaron did the pixel counting on, and also gets you to adjusted EBITDA of minus 26, both within the range of their guidance here, minus 29 to minus 26 adjusted EBITDA. They often hit their range or even surpass their range, and then this adjusted gross profit of 60 million there. So to get there, if you put in 70% loss ratio here in my model, now you're only at 52 million adjusted gross profit, so a little bit low, and minus 33, so outside of that range. So my guess is we're going to have a very, very good loss ratio for Q4. It's going to be seen as a very strong quarter. Also, this was in the Q3 earnings call as well. Another note said Q4 is a tricky one. It says Daniel, but This was actually Tim who was speaking. He said it's a tricky quarter because generally the loss ratio tends to be a fair amount better than the other quarters. Has a few comments here. You can pause it and read it if you want. But he says the combination of something has led to a great year-to-date period, and the Q4 numbers we hope will come in as expected or better. So some bullish comments on the loss ratio and how in Q4 in general of what it might look like results-wise. Also, if we just pull up, say Progressive, for example, another insurer, I'm not going to pull up every insurer, but if we look at their net catastrophe loss ratio, so the effect of catastrophes on their loss ratio on property and company-wide. This was just for December even. They release it monthly, but for December was 19.9 and 1%. So a stellar result of minus 19.9 and minus 1%. So the catastrophe side of the equation for them was non-existent or even helping their overall loss ratio. So in summary, Q4 I think is going to be really, really solid. You get that you're in the range here of adjusted EBITDA of what their guide was. You're beating their top line maybe by 1-2%, IFP maybe even more. Maybe they have a much higher beat. We never know. They have beat it by even more significant percent wise in the past. And earnings per share perspective, I'm at negative 0.6 or 60 cents. Loss on the earnings per share. I'll just note here, won't go into it briefly, but based on where we're at right now, based on what value you project out the company could be worth in the future, I have 2035, 2032, 2029. I think the best one to look at is 2032 because they gave us management gave us a blueprint that they basically plan to grow to 10 billion IFP by that range. So that's a little more of a clear guidance versus 2029. You don't see the result as quickly or as much. But if you're saying, hey, if you're giving a 30 PE on their earnings in 2032 and you discount it back to today at 10% a share, it's saying, hey, it's worth $92 a share. If you look out further and you continue to extrapolate out further, of course, there's less certainty, but you're saying they're worth over $200 a share. So it's somewhere in that range. If you're looking too close to the present, if you're looking out only, to a couple years out, then you could, I think, argue you could have a much higher multiple and you'd have a higher, maybe it's a multiple of, 60 in that range. And you could say, it's worth at least $60 a share then in that range. But it depends, how you factor in what P you're giving at that future rate. But that's kind of a quick valuation from where we are right now. But overall, Q4, I think, is really going to be in the bag. Phenomenal quarter from a results perspective. But the market will, of course, be wondering what's happening with the LA fires, what's happening in 2025, and almost probably care about that more than necessarily exactly what Q4 is going to bring. So for the LA fires, to summarize that, the current estimate for insurable damages, what I'm seeing is maybe 20 to 30 billion of insurable damages, and I did another video all about the fires. I could link that up above here if you want to watch that whole thing. But say you put in 25 billion of insurable losses, and Lemonade has, of the property and casual market in California, they're at 0.2%. Or roughly we're at that. I think that was in the 2023 report, so it's a little bit old. It might have changed just barely. But if anything, I would think it's probably gone down because they've been canceling. They've been talking about for 2 years how they've been canceling policies, home policies in the worst areas, and they showed, 2+ years ago that these home policies in Los Angeles were not feasible enough, were not economical, would have a negative lifetime value. So I'm guessing they probably pulled out of a lot of that. But anyways, across all of the P&C market in California, the property and casualty market, they're at 0.2%. And if you assume, what's sort of the overall density across all of California versus the affected zone, the areas that were burned by the fire. If we say they were 50%, so they were diluted about 50%, and they had just a small fraction, 50% of 0.2% of all the property and casualty losses there. And then say 50% was covered by reinsurance. You get down, do the math here, and you get down to 12 million in losses. Now, let's say the worst end, maybe it's 30 billion in overall losses. This 0.2%, I don't think is going to be changed. It's going to be probably the same, like it said, or maybe less. Maybe it's 100%. and maybe reinsurance doesn't cover as much as we thought because there's certain limitations. Maybe you're hitting 42 million. That would be that'd be a significant loss for the company. That would really hurt. It would hurt the Q1 numbers significantly, but it wouldn't be catastrophic to the company and the thesis as a whole. So that's sort of my take. How I'm thinking about the LA fires. That would be the worst case, but I think more likely they're going to have less, and reinsurance is going to cover more of it, and maybe you're going to have 15 million in losses, something like that, potentially even less. The whole book, maybe 10 to 20 million kind of in sort of losses to Lemonade. Now, if we look at 2025 as a whole year and focus on that, if we go back to, and this was a slide from Investor Day back in November, basically said these key three numbers here are really important. They say 40% increased growth spend, so a huge bump on the growth spend from 2024 to 2025. Adjusted gross profit is supposed to grow 50% a year, which we flip all the way back to Aaron's slide. Makes sense because we were at about 160 here, and now we're going to be maybe 250 range over here. So that checks out and makes sense. And then they're expecting about 1.2 billion in IFP. I've tweeted about this a few times. I don't know if the 1.2 billion really makes sense, which I'll illustrate here in a moment. If they're going to spend this much on growth spend, which they're planning to spend about 120 million in 2024. So if you add 40% to that, you're planning to spend about 168 million in 2025. So if they're going to spend 168 million on growth spend, on advertising, on customer acquisition, as cars ramping, it's hard to see that they're only going to reach 1.2 billion. And in my mind too, if you think about 1.2 billion, let's say 1,200 million or 1.2 billion divided by, say they end with 959, like I'm projecting, of IFP, that's only 25% year over year growth. And if they're projecting to grow 30% a year for the next sort of foreseeable year or foreseeable future until they 10x the business, my guess is it's going to be easier to grow more than 30% in the closer years because your book of business is smaller. It's much easier to grow 30% on 950 million of in-force premium than 30% on 10 billion or 8 billion of IFP. So if anything, your year over year sort of numbers should slowly decline, and you'd think in the sooner years like 2025, 2026, 2027, you're going to have more than 30% would be, my thought would be, intuitively make sense. But I think this number is too low, and let's dig into it further to illustrate that. Yes, as I mentioned here, you can see we're at about 250 million of adjusted gross profit is what we can expect for that. So looking at my Lemonade model here, a just temporary model for 1.2 billion of IFP. I'll delete this tab later versus my sort of typical model, what I'm looking at or thinking. But this one to illustrate this for you guys, where I'm thinking, hey, how do they get to only 1.2 billion? What would it take to reach only 1.2 billion of in-force premium at the end of next year? And by the way, if you want to support my channel, you want full access to this model and other exclusive content, you feel free to join my Patreon. Really appreciate it. It continues to grow, and the number of people joining there seems to always be increasing. So thank you to everyone who's there. It's so awesome, super encouraging. But the way I modeled in the past is I was trying to predict what the IFP would be based on their comments, of they're showing us kind of what the IFP might be, or showing us, hey, they're going to grow 30% a year for the next number of years out into the future. What I'm kind of doing it in a bit of a reversed way. So down here in my model, further down, I have a breakdown of renters, home, pet, car, Europe, life, and I gave down a breakdown of each, and from that I am I'm predicting or estimating from their sort of long-term guidance how the IFP might grow year over year. So in this one, though, I'm siphoning this specific, model with the red header here, just siphoning or restricting this back to the only 1.2 billion of IFP growth. And then I'm putting that in my top line, higher up in my model here, those same values. Of saying, here's what they're going to reach, here's what they're going to grow to. And then based on that, I have a customer acquisition or their growth spend conversion to IFP, but I'm excluding what I'm calling as cross-sell. So cross-sell is of dollars of premium that are sold simply from someone cross-selling or upselling, from one policy to another. So they have a renter's policy, and then they get a pet policy, and then they get 2 car policies. Those would all be from the same customer, cross-sell, upsell. It's a huge dynamic that's part of their marketing. So down here in my model, I have it highlighted. I have percentage of IFP that upsells or cross-sells. I have it at 32% in 2025. It could almost say 33%. But I might actually guess we might be more in that range already, and it's going to move up to 34, and actually only have it at 34. It could probably be in other years. We'll see maybe some adjustments, but you could almost say that's going to move to 36% as CAR really is ramped out and pushed, because we know back a few years ago in Illinois, when CAR was released in Illinois and it was pent up, there's demand for the product there. It was about 36% of all sales were upsells, cross-sell, jumped up from that from like 20%. So anyways, and as a whole, Daniel said it was I think a few quarters ago on a Say call, I think it was at the end of last year, one of my Say questions, Daniel said they were at about 30%. So I have it about 30% through this year, and then increasing up to 32, and then going higher of the amount of cross sold. And then when you subtract that out of the equation, you're left with a historic value of, hey, you spend $1 on customer acquisition, and then you get however many dollars back in IFP or in-force premium. You can see a graph of this here, excluded the Metro Mile acquisition quarter here, but as you can see, it's sort of varied from 1.4, 1.9, 1.8 all the way up to 2, 3, and this is mostly a function of how much they're spending on growth spend. So if they're spending less on growth spend, you get the most profitable dollars sort of converting business over, and you get those higher bars. If you're spending more on growth spend, then you get less. And it's sort of a back and forth function, but of course it's also a function of what products they have available where, and they're comfortable pushing. So as CAR rolls out, this should allow them to ramp up and increase this growth spend, while still, I think, keeping this conversion fairly high. Will kind of start to bend the rules there, break the rules, is my prediction, is my guess, because CAR is such a massive product that they're really just barely starting to tap into now. And I mentioned this in my Patreon. This was back January 25th. I made a little post there, said marketing efficiency should stay strong, because I think they'll be able to stay, if you look at CAC to IFP excluding cross-sell or customer acquisition costs or growth spend, kind of a little bit interchangeable how I'm using some of that language. But I think it's going to stay in the 1.8 to 2 range even as they scale up marketing. Now, why? It's because the car market is massive, just as I mentioned. The car market in the U.S. is a 400, maybe, this was from Grok, but it said it's about a $400 billion market compared to a combined $10 billion for renters and pet insurance in the U.S. So they're going to keep winning in renters and pet. People are going to keep, pet's going to keep growing. Renters is probably going to keep growing. They're going to keep winning and growing their market share there. But they have hardly anything. They're just like barely scratching the surface of this massive market. So as they scale and push into car, of course, they're going to cross-sell the existing customer base to car, but they're also going to put marketing growth spend dollars directly into car customers and acquire customers that maybe they're not getting any other policy from LMND, but they are getting their car policy as their first policy. And then as a reminder too, from Investor Day, you can see that 700,000 customers, the existing customers on their car wait list. So it's a ridiculous amount of customers, 700,000. If you multiply that by, I think it's like 1750 approximately their average, you're at 1.2 billion of IFP demand, sort of pent up potential demand, more than all of their entire book of business right now is just sitting there almost waiting to be organically sold from the current customers that they have acquired. So, and this kind of follows too. It says 1/3 of total sales are organic. I don't know if that's per customer or per IFP. Probably doesn't matter. It's probably maybe similar either way. But that goes back to what I was showing here before in my model there, or if I scroll back where I was showing down here, hey, it's about 1/3 of IFPs cross-sold or upsold. So that's why it probably could even bump this up to 33%. Might do that later, but it make a small difference in the results that we're kind of looking at or looking to understand for this year. But flipping back to this 1.2 billion IFP guidance model, so if to get to 1.2 billion for the end of 2025, what it takes, with that 32% conversion, now that you kind of understand some of the mechanics of how this, how I'm modeling this, it takes a 1.3 ratio to then spend about 168, I have 167, but close enough to 168 million of their IFP, of their expected growth spend. Because remember, they spend about 120 million in 2024, and they're going to spend probably 168 or 40% more in 2025. And so in order to spend that much money, and the unit economics means you need a 1.3 ratio to make this number happen. That accounts for everything. That accounts for the amount of customers are churning away, or the annual dollar retention you're having as customers churn away. So it's a pretty low amount. And if you flip over, back to this customer acquisition to IFP conversion, excluding cross-sell graph, 1.3, we've never seen a 1.3 anywhere since 2021. When I have data going back to this for. So of course you could say, well, maybe as the growth spends ramps up and they're averaging, this is almost 40 million spend, and the Q3 was a 1.49, so not a great, less strong ratio. You could say, well, for next year, they're going to spend 42 million average, see 168 divided by 4. And maybe they're going to, it's still, even if even just based on that average, say like, 142 million a quarter, then why would this drop down to 1.3? It seems odd to me. Seems a little suspect to me, a little bit sus. Especially when you consider what I just mentioned as well, that, hey, they're just starting to tap into car, which is 40 times the market that they're mostly playing in as the renters and pet insurance market, which they're mostly acquiring customers that are renters and pet insurance customers. And now they're just starting to jump into this market that's 40 times the size, or roughly, something on the order of that magnitude. So it doesn't make sense to me. Then it means, in my mind, you're going to have lots of car customers, that pent up demand, people that maybe don't even had a Lemonade in the past and moved and now don't have it, but still would buy the car insurance product if it was available, and could be easy conversions over to there. They're this low hanging fruit. It seems really odd that they'd only get to a 1.3 ratio, but that's what the math is showing me. If this slide that they put up here that is at all accurate, that they're 1.2 billion. So I'm really hoping Lemonade does not guide that low and says, 2025 is going to be 1.2 billion and 25% growth for the year over year, or something like that. The market is going to hate that, and I think it's going to be way too conservative, not realistic to what they're projecting or showing here. Now I'm going to show you another version of the same model that says, hey, what would we get to if we just had a 1.9 version, conversion, which is roughly, where these quarters were, as a rough average, 1.98, 1.7, 1.92, 1.46, 1.82, and some of these as well. And, at car, it's really hard to predict this because we don't know exactly when car starts to ramp on the whole book of business as a whole, what the unit economics are going to do. We're going to learn a lot about where Q4 comes in at, on this table. But say they get 1.9 just for illustrative purposes, and I have another model here, it says 1.9. For a 1.9 conversion, it ends up meaning they're going to get to an IFP that's closer, almost close to 1.4. So this is probably too high. This is not, what I would predict, but it shows you that kind of level of aggression. If they got to 1.9, you might be having like a 40+% year-over-year growth in IFP, almost touching the $1.4 billion mark. It'd be like insane, massive growth in CAR in 2025. I don't know if they're going to push CAR and everything that hard, or if they'll get that kind of a result. I would say probably not, but I'm kind of showing, the lower end of the sort of range of outcomes was with 1.2 billion, and now the upper end would be like a 1.4 billion, and it would take this sort of 1.9x ratio. It would also get adjusted gross profit of 268 million. Remember, we had that slide from Aaron again. It was 250 million. We would be on the cusp of adjusted EBITDA profitability. By the end of next year might be like minus 13 million, a very small amount, and then the next quarter already might even be hitting profitability at the start of 2026. Earnings per share would come in at about minus $2.3 per share for the whole year. I think analysts' expectations are more like minus 2.6. So it'd be a really solid beat that way as well. It'd be a really, really strong result if the marketing unit economics or anything like that. And again, I think we're going to learn a lot more of what they might be in Q4 after those Q4 numbers come out, because I think Q4, there already were signs that CAR was being pushed more heavily and advertised more heavily in Q4. Finally, what I'm thinking might be more realistic is I'm putting in a 1.65 ratio instead of 1.9 or instead of 1.3 like the other two cases, where 1.65 sort of a middle ground. That still gets you to just over 1.3 billion of IFP, a really like a high 30% year-over-year growth, really, really strong growth. And again, in my mind, that makes more sense that you're going to grow faster in some of these early years, and then it could maybe, the later years of their sort of 10x projection of the book of business are 29%, 28% growth, and then these sooner years are a higher percent growth, would, in my mind, maybe make a little more sense. And then if I scroll down, based on that, you have adjusted EBITDA of a minus 110 million for the year, earnings per share of minus 2.5. So a bit of a beat on what maybe analysts are thinking. And then you're still having an adjusted EBITDA is still in the minus teens at the end of the year for Q4 of 2025, and then really knocking on the door 2026 and then hitting profitability in that year. So regardless, whether it's 1.65 or 1.9, anywhere in there would be really strong result. If it's only a 1.3 ratio and we're only getting mid-20% growth based on how much they're spending on growth spend, 168 million, that would not be a good quarter. That would not be, in my mind, a good year and not a great sign as for their overall unit economics. But I don't think that's going to happen. So I hope they don't, they think carefully about that and they're not guiding that conservatively. Now, speaking of guidance, I released a post about this a little while back in my Patreon and had this little table here of different quarters and their revenue, in-force premium, gross earned premium, adjusted EBITDA, what they guided and what they actually did, and the percent change or beat across each one of those. So if we look at each one individually, just briefly here, IFP, of course, the book of business was much smaller back, in 2020 than it is now. So maybe percentage was, of course, same percentage amount, same 3% was a lot less IFP dollars back then than it is now. But still, you can see that sort of percent change of IFP guide versus actual has been trending down. So I hope we get, guidance. I hope we get, something, maybe a 30% guide. It would be my hope on IFP beat. So that might be, if we get 959, like I'm showing in my model, 30% on that would be 247 million of IFP, so I'm hoping we get like 250 million of guidance for in-force premium, because I would at least I'm hoping we get 30%. Even more than that would be great. But that's my hope. If they think that's realistic, looking at the numbers here, what I'm looking at, I think that is going to be realistic. Of course, they know a lot more, have a lot more insight into the numbers of all the real details that we don't have, and the real time details. But that would be my thought. I hope we get that kind of a guidance, that it's like 1,250 is the guide, and then we actually get 1,300. I think that would be fantastic. The market would love 1,250. If they only guide 1,200, I think the market's going to hate that. But somewhere between there, 1,240 would be maybe the minimum, and 1,250, and then they actually, do 1,300 or high 1,200, something like that, for the year would be phenomenal. And finally, I just want to mention General Catalyst, which has their synthetic agent financing. I tweeted this out. They had an 8K just a couple days ago, a couple days ago, where they're increasing the amount that Lemonade can essentially borrow from General Catalyst from 140 million in 2025 to 200 million in 2026. And maybe that means 200 million in 2026 is a bit of a sign that General Catalyst is optimistic about the agreement and confident in the cohort unit economics they're seeing. And then also Lemonade is maybe planning to continue to ramp their growth spend in 2026. We could also flip back to this chart right here and do some modeling for 2026 of 350 million of adjusted gross profit. But that will be another video. This one's focused on Q4 2025, 2026. That will be a whole other thing I'll be breaking down for you guys based on that metric there. But I also posted this. It was I have a Discord with my Patreon, but some of us were talking there a little bit about it, and put this here on X as well, saying it's for me this renewal at 200 million is mostly a positive sign, because it means they're seeing these positive unit economics. And the main thing I'm like really thinking about, really wondering is, will the unit economics hold up as they scale growth? If we flip back to some of these graphs here, like as this blue line increases, how is this pink bars going to hold up? And again, I believe my theory is, as CAR is rolled out, then it's going to stay really strong conversion. But of course, we don't know that. Like I mentioned here, we don't know that 100% for sure. But General Catalyst investment shows they're seeing positive results and are confident investing even larger amounts into the future. And it also means on Lemonade's side, they want that kind of agreement that they can borrow even a larger amount if they need it. And that probably means they're going to continue to accelerate their growth spend. And if they're doing this, they're also seeing these unit economics as favorable. This conversion to IFP as well as LTV to CAC. The other way you could kind of measure your growth spend unit economics, which I've touched on in other videos. So, and if Lemonade's ramping up faster than they were even expecting, they might need more of that investment from this program, General Catalyst program, because they kind of need to bridge. They're pushing harder, faster acceleration. They're going to need more of possibly need more financing to bridge that investment cycle gap until essentially the customers you're acquiring pay off the cost to acquire them, and then are becoming cash flow positive into your system. So that's my take on that. I think that it is a very positive sign that this renewal took place and that it's at a higher amount. Thank you so much for watching. There was a lot we covered. Let me know down below in the comments what you thought, what I missed, any questions you have on anything, and I'll try and get back to you. It's exciting times for Lemonade, and thank you so much for watching. Remember, it's in the bag.